You do, Josh, have the best two-day gain for the NASDAQ since March, and you as well have a VIX that is still somewhat elevated given the strength of the rally. We're above 31. So take all of that into consideration and tell me how you feel with this move today.
So I think it's very important when we're in the midst of a bear market rally to be measured in terms of like how far we think these things can go or how long they can last for, because there are no rules of thumb that are helpful here. And as we see this morning's gains start to melt away, one of the things I like to tell people is don't be sad it's over. Just be glad it happened. We did need a break from the new low machine, and we got it. And a lot of people have now had a chance to reassess where they are, what they own, how much cash they have, how much bonds, how much stock. It's hard to do that in trending markets up or down. So it's nice to be able to just catch our breath. Let's take a look. 35 companies have reported earnings for Q3 so far. It's still obviously very early. 68.5% of those companies have beaten estimates, which is lower than the prior four-quarter average of 78%, but above the long-term average of 66%. So far, I think the most constructive thing you could say is that this is a normal, quote-unquote, normal earnings season, and really nobody should be jumping out of their chair for joy, and nobody should be in tears.
Yeah, we haven't had any blow-ups yet, and maybe it's too early for
Get
that.
ready.
Well, maybe it's just too early this earnings season for that. Jenny, believe in it or fade it? I ask you that as Jonathan Krinsky of BTIG today says fade it. Quote, we think the recent action is telling and has tended to occur in the midst of bear markets more than the start of new bulls. We don't think we're at the final end of this bear market. Therefore, we would be inclined to fade this rally. That's what Krinsky of BTIG says. What about you? Believe it, fade it, what?
I think when you put it into those black and white camps of believe or fade, you're really putting it into trading terms. And I'm an investor. And what I look at is that we've been in a bottoming process since June. I don't know how long that bottoming process will take, but we had a lot of excess. And we're reconciling and consolidating that excess right now. And I think we're actually doing it in a way that when we reflect back in 2 years, we're going to reflect back and say, like, hey, that was pretty healthy, actually. We went from 21 times earnings down to 15 times earnings. A lot of people are hurting, but a lot of people are okay. We need to remember there's a real mismatch out there. You've got ARK and those kind of nosebleed evaluation stocks down 62%, S&P down 23 and change, dividend stocks down 9. So there's a lot out there, and I don't think it's either or. If you are a long-term investor, just stay the course.
Yeah, but
if you're a trader, Scott, I don't know how to account for that because the moves are too emotional. And that's one other thing too. Like, if you ask me right now, what's the biggest influence of the market? I would say it's actually not inflation, it's not earnings, it is sentiment. And you look at the University of Michigan sentiment story, you look at Ed Yardeni's Bull Bear Index, those are at historic lows, like the lowest they've ever been since they were measured. This is not as bad as the Great Financial Crisis. This is not as bad as the worst of the pandemic. So emotions went too far. We're going to waffle around, but I think we're in a bottoming process.
Okay.
If you want to get in now, you can.
Okay. We'll come back to that. If you want to get in now, you can, because there is debate about that. And I would also say to you, yes, you can correct from 21 times to 15 times, and you paint it as, oh, no big whoop. I would suggest to you, well, 15 times what?
Okay,
15
fair
times
enough.
what? And we'll get back to that in a moment, so hold your thought. Krinsky's not the only one suggesting that you should fade the rally. It's Wolf as well. Short-term rips lead to deeper dips. Despite the potential for a near-term risk-on rally, they're bearish to the end of the year. UBS, we don't believe that conditions are in place for a sustained rally, and the risk-reward for markets over the next 3 to 6 months is unfavorable. You want to take issue with any of that? I don't think you do. I think you kind of agree with that.
No, what I want to say
despite the fact you're choked up about it.
No, sorry, God, talk about bad timing. You know what I want to point out first? I'm going to come right to this. It's 5 minutes into the show. You know what word has not crossed anybody's lips? The Fed. 2 words, okay. But
Thank
5
God.
minutes.
Thank God.
Exactly. And I'm not being a smart aleck here. I think this is strongly why the market has a little bit better sentiment right now. We can focus on fundamentals, particularly where I like to live, and I think Jenny and Josh do too, talking about specific companies, whether it's Goldman Sachs today, whether it was JP Morgan last week or Delta Airlines. I think we have looked forward, I know I have, to this earnings season, Scott, because we've been so focused on the Fed and on technicals, speaking to Krinsky and others, that where people like me really want to live is listening to companies say what is going on in their world. So if it's Bank of America's Brian Moynihan yesterday saying the consumer looks pretty good, I mean, that's paraphrasing, but that's what he said.
Yeah.
He
was kind of cautious, though, right? Solomon's cautious, Goldman CFO cautious.
Everybody has to be,
today.
Right? I mean, let's talk. Now I've brought up the Fed, right? So we have raised 300 basis points. We're likely to be at 450 by the end of the year. So, of course, that's going to have an effect.